Welcome back, everyone, to Vox Markets. My name is Paul and I'm delighted again to be able to speak to CEO Steve McQuillan and CFO Steve King of Avingtrans, a specialist engineering firm. So welcome, guys.
Welcome to you as well, Paul. Thanks very much for having us.
Yeah, well, big congrats on this morning's inline interims. But before we sort of dig into the details, Steve, I don't suppose you could quickly sort of walk us through what the current demand picture's like, given the geopolitical concerns, and likewise, just perhaps some of the highlights from the results.
Sure. I think from the point of view of the geopolitics, quite a lot of that doesn't really affect us that much, at least not so far. Who knows what's going to happen next? But for the most part, that we're bypassing a lot of that. What we've certainly seen, and this is more of a COVID effect rather than anything else, Paul, is order delays in various places. And that's affected the EPM division more than it's affected the other divisions. And that's because the EPM division is more global. It has different businesses in different places and it has product sales to a lot more countries. So I think there have been interruptions in supply chains, there have been order delays, there have been COVID effects, logistics effects. That's all kind of been evident there. It's gradually easing, but that's certainly been an effect, probably not just the last 6 months, but probably for the last year or more for those guys. There's been much less of that in the PSRE division because that's really more domestically based. A lot of what it does is UK based these days. And medical, of course, is more of a startup, as we'll get back to later. But it's also seen some supply chain disruptions, but it's getting on with it quite well. So I think we're okay. Overall.
So overall, then the key markets is the sort of the take that investors should draw is that a lot of the demand is driven by regulatory necessity or that is basically process critical or safety critical type of
exactly. Equipment. So you know the kind of markets we're in are exactly that. They're regulatory, highly engineered, highly regulated markets, and we like those for that reason. It means that it's more stable. If you're looking at energy demand, it goes over decades rather than over a few months or even a few years. So that tends to mean that the orders are relatively stable. As I say, we certainly have seen some order disruption in EPM, which is mainly about COVID. But we've got good evidence that that's now, coming through okay, and so should be fine for the year end. We'll dig into that a little bit in the numbers, I'm sure, in terms of the individual divisions.
Okay, so just on that, on the EPM and the engineering pumps and motors, can you just talk us through, because you did say that you got some contract. Is that the reason for the slight revenue decline? Yeah,
basically they've seen some order delays, some of which have been received post the first half, so we've got them now, or we know they're coming. So we're pretty confident about the year end still, but it certainly held them up in the first half to an extent. But as I say, we're seeing them come through now. Steve, do you want to comment on that one?
Yeah, I mean, normally it's 45-55 hour split, Paul, H1, H2. And this period, it's 40-60, sort of 40-60. But, you know, the aftermarket's still holding up at over 70%, and there's been an uptick in the EBITDA. What we're seeing, as Steve mentioned, is the international travel for some of the end customers has been still difficult. And that's meant delayed orders or orders taking a longer time just to get to fruition. And also in the US, we're still seeing the US nuclear sites being reluctant to have people on site to get those orders. But there's got to be a backlog there, and hopefully there will be I was going to say a glut, but a slow increase over a period of time.
Well, that slight decline was sort of mostly offset anyway, wasn't it, by the process solutions and rotating equipment division. Do you want to take us through that one, sort of what's driving the growth there?
Yeah, there's a number of factors in play there. Of course, we've got the recovery in the booth business, which you remember makes high integrity blast doors, security doors. That continues to grow back from strength to strength. You remember we bought that a couple of years ago and it was basically bankrupt to that point. So it's recovered really nicely and continues to develop well. We had also the good news in the first half about the Sellafield nuclear waste boxes contract moving to the second phase. So that's helping Metalcraft move forward there with that type of contract, that type of business. We also had good progress at the fluid handling business in Scotland. Again, some of that Sellafield related, but other contracts as well. And even Ormonday, where they had quite the sort of derailing from COVID because of construction work grinding to a halt in various places. They've seen some really good orders coming in now, actually, in particular for large plant rooms. So for big buildings these days, you tend to build the plant room for the heating, ventilation, air conditioning, that sort of stuff off-site, and then bring it into site on modules, and it just plugs in like a big set of Lego. So they've seen a number of good orders for that type of equipment coming back in, which had been absent for a while during the pandemic, but starting to come through nicely. And some other bits and pieces, but those are the main moving parts there. So PSRE as division's done well, and we expect to continue to do well during the rest of the year. More balanced though, Steve, I would say for the year 50-50 more like.
Well, certainly 50-50, and that's helped by these long-term contracts for HS2 and Sellafield, Steve. You know, it's much more balanced, as we've always seen. But that's because it's been UK based, and we've been able to get out over the past 12 months.
And what's the opportunity to sort of ramp up international orders? Because you've got that expertise already developed in-house in the UK and deployed with great sort of reference sites. So sort of like taking that overseas, and also sort of like lifting the proportion of aftermarket services perhaps higher for that division.
The best opportunity there is with Booth again, because it's never really done much outside of the UK. Well, certainly not for the last number of years anyway. But it's got an opportunity to certainly go internationally in certain markets. Again, these are so highly regulated, you have to pass individual tests in individual markets. But it means, for example, that markets like Australia, which are very similar to the UK, are open to Booth. So we're investigating opportunities there, for example. And the point you made about aftermarket is a very good one. Having sold Peter Brotherhood last year, the PSRE division has rather less aftermarket opportunity than it had before, because Peter Brotherhood was about 50-50 OEM and aftermarket equipment. But what we're doing is building up the aftermarket in Booth and Ormondy, to a much less extent Metalcraft. The boxes don't have much aftermarket for Sellafield, but there is an aftermarket opportunity in most of the businesses, but particularly strongly in Booth. And we've got a really good aftermarket team there now, in fact, and they're starting to win some really nice contracts. One they've won recently is with the Queen's Flight, actually, to look after the hangar doors for the Queen's Flight. Not the biggest contract, but very prestigious. So we're really pleased to win that, for example.
What's the Queen's Flight, just for investors?
This is her own aircraft that she uses to move around.
Oh, is it? Okay, so it's a bit like the Boeing One out in the States, but
yeah, it's not a big aircraft like that, but it's a private aircraft they used to move members of the royal family around, and we're looking after the hangar doors. As Steve always says, somebody's got all the hinges, somebody's got to look after these doors, so we're doing that now. Good.
Now, Steve K, can you just walk through the increase in the margins and what's driving that? I'm guessing it's more aftermarket, but can you just take us through and perhaps give us a colour on it?
Probably slightly different in each of the divisions, Paul. I mean, EPM, EBITDA was up to 14.1, so a slight improvement, and we'd like to see that improvement year on year. As you know, we like to target businesses that we can see under the pie strategy that we can make at least 15%. But there's always a mixture of businesses in there, and the maturity of the businesses as we get closer to that 15, you can see where we are. So EPM had some restructuring, if you remember, last year, so I think we've got a bit of a benefit there. But also aftermarket has held up well, and some better margins. And maybe with PSRE, it's all about, I hate to say it again, sort of the booth contracts being older booth contracts trading out, getting them better margins. And, you know, it's the engineers understanding what value they add with those high integrity doors or anywhere. Engineers love to engineer, but they don't always like to sell their soul.
Okay. Now, I did notice on that third and final division, but lots been happening. Do you want to take us through Magnetica and what the strategy is and the timeline? I see you've got the product being ready at some point as well, fairly soon. So do you want to sort of give us a bit more colour on there?
Yeah. So remember, for everybody's benefit, Magnetica is a business we bought the majority of in Australia last year, and we merged it up with two of our other businesses in the UK. And its objective is to enter the market for compact MRI systems, not using helium. And the point about that is that if you make them smaller and lighter and cheaper and don't use helium, then they can fit into places they wouldn't otherwise fit. And what we're really after here in particular are markets like orthopedic surgery for your arms, your legs, your knees, your ankles, etc., and veterinary surgery. And we'll come back to those two markets with another investment we made in a company called Adaptix in a minute. But Magnetica's aim is to get into those sorts of markets, and the first one being orthopedics. And so we're working on a smaller MRI system in that regard. We're making really good progress. Again, like the other businesses, they've seen some supply chain disruptions in the last few months, but they're knife and forking their way through that okay, and they're still getting on with it, such that we still expect to be in a position to actually launch a product into orthopedic surgery towards the tail end of next calendar year. But to get to that point, we'll have to have product ready for clinical testing towards the end of this calendar year or into early next year. So we're making good progress there, and we're quite happy about it. All the key components are coming together nicely. There's a lot of work to do still in software and integration, etc., but it's coming together really nicely. And then what we've also been working on is this other business, Adaptix, which is based in Oxford, is following exactly the same path as Magnetica on 3D X-ray. So they're trying to disrupt the X-ray market with a small scale system that, again, you can fit in anywhere and needs a lot less shielding, uses a much lower dose X-ray, but uses a solid state source. So in fact, what it does is not take one X-ray picture of your wrist or your elbow or whatever, but takes multiple, like a burst photograph of your elbow or your ankle or whatever it is. And the advantage of that is that you can get much more interesting images and much more detail on the X-ray images. Now, these are complementary, these imaging techniques, because as you'll know, Paul, MRI is for soft tissue and X-ray is for harder tissue, bones, etc. So they're parallel, but they're very complementary. And the great thing for us is Adaptix is about 15 months ahead of us, maybe 18 months ahead of us, and they've already launched a product into orthopedics. So that's brilliant because they're already trailblazing for us in terms of the same sort of distribution channels, the kind of clinical testing we've got to go, the clinical acceptance of what we're doing, some of the software, some of the imaging software is all the same sort of stuff. So we're merging up those bits of what we're doing between Adaptix and Magnetica and trying to be more efficient between the two businesses. You know, we'll see where that leads later and how far we go with that kind of merger activity. But certainly there's a really good synergy opportunity between the two businesses, which is why we've invested £4 million in Adaptix, which gives us 12% of that business at the moment. You know, more good work to come there. Really excited about what those guys are doing. The other good thing they're doing is they're already trailblazing the paper scan type model that we want to do with Magnetica as well. And again, so far so good. It does like good chunks of the market are going to accept that sort of idea. And we see that as being ultimately a much more beneficial kind of business model, a bit like software as a service as opposed to just selling software. We think that ultimately that's the right way to sell these products. But of course, that needs you know, bigger balance sheet, more money. So we know at some point we'll be looking for further investment in Adaptix and Magnetica, not just coming from Avingtrans, but coming from third parties as well.
Right. Well, you've certainly got enough money. There's no doubt about it. Steve Kay's done a great job there. But just before we move off Magnetica...
More Scottish than I am, I keep telling you that.
But just before we move off Magnetica, just remind investors what the sort of the total addressable market is and whether there's any rivals in this space at all who are already going for small form, helium-free sort of X-rays, you know, X-rays or MRIs.
Yeah. I mean, the total addressable market between the two of them could be up to $3 billion. It's about 20% of the total imaging market, and across those two modalities, it's roughly a $3 billion opportunity. Now, obviously, we won't get all of that, but it's a big target to aim at, which is why we're really excited about it. And that doesn't count veterinary, of course, because there isn't really that kind of effect for veterinary, certainly not for MRI anyway. So there's probably more to go at when we get around to that type of market. There are other people trying to do some of these sorts of things, but they fall into two camps. They're either people who are using permanent magnet solutions for MRI, which give you much lower quality images, and so they have a limit to what you can use them for. Or on the X-ray side, they're still trying to do whole body, so it's a big full-scale system, not a small form system targeted at certain niches. So I think the advantage we've got is that we're targeting, both Magnetica and Adaptix, targeting certain niches of these imaging markets, but sizable niches, but they're still niches nonetheless. That kind of takes us away from competing with the big guys, because we're effectively trying to create new niches or build on new niches that other people aren't really targeting directly. Some people can overlap with that, and they can, you know, not only the big players like GE and Philips and whatnot, but they're not targeting these niches directly. And we think the direct targeting of those niches, plus the business model we're going after, and the quality of the imaging that we're going to produce here, is going to be what differentiates us from anybody else in some of those market areas.
Right, brilliant. Okay, well now, Steve Kay, just moving on to the supply chain and input cost inflation. How is the business faring with higher input costs, and has it sort of been able to sort of transfer those out into price increases or absorb them, or because obviously your margins actually went up, didn't they, year on year, which is a good effort.
Yeah, I mean, I think we're seeing some significant price inflation probably since the half year results have come out, but they fall into two camps. So we've got the longer term contracts for example, HS2 or the Sellafield contracts, where typically price increases are linked to indices, which are typically linked to inflation. Sometimes they work in our favor, sometimes they don't. So they normally have got a pass through. We tend to back supply. For example, for the Sellafield boxes, we've got a big supply contract with our material supplier, so it's all back to back. But it does always take a little bit of time and negotiation. People don't pick up the phone when you're looking for a price increase. Similar as I don't pick up the phone when they're looking for a price reduction. That's life, isn't it? And then you got the shorter term contracts. And shorter term contracts, we just had to squeeze down the order validity time. So it's less than a month now, and we're constantly rechecking with our supply chain that we've got the right prices in there. And I think that's all you can do at the present moment in time, particularly in material costs. People resources, well, as you know, we've got this long-term strategy with bringing in apprentices in. And you'd have probably seen that the apprentice school down at Chatteris at Metalcraft is ongoing and will hopefully take its first intake in September. So that's great. I mean, the board were down there the other week and we're very impressed with that. It's a really nice building for Chatteris itself.
Great. And how's just top level? How's trading been since sort of November? The visibility for the full year, is it looking? It's obviously all on track, but just perhaps touch on that.
I'll let Steve comment as well, but it's slowly improving. As I say, you know, we've seen some orders come in that we were waiting on for EPM that were late, and we've seen some other good orders come in around the division, including actually for Magnetica. We rarely talk about their orders because their main activity is around M&I, but they've had a couple of cracking orders early in this new year for physics magnets for universities. So even they're seeing some pretty good orders coming in actually. So overall, gradually improving position, with less delays going on, less things being held up. But, you know, still expect a few bumps along the way before we get into smooth sailing again. Again, assuming nothing dramatic happens around the world elsewhere that we can't control.
Yeah, and with land prices increasing, how are we getting on with the spare sort of site out in Luton?
Yeah, it's been a frustrating journey, that one, I have to say, Paul. It's still ongoing. We have a preferred partner who I won't mention if you don't mind, who we're working with there. And it still is looking quite likely, so we still hope to do something about that this year. But it's been a really slow and frustrating process, and that really has been held up by COVID. It really sort of slackened everything off, and we went quite backwards for a while. But it's still looking good at the moment, and we're still planning on a new site, and we're working on that new site in detail now, again in the Luton vicinity. So we're working on that to see whether we can secure an appropriate smaller site for the Luton business.
And then Steve K, I mean, one of the silver linings, I guess, of all the global uncertainty, whether that's sort of central bank tightening, higher inflation, and also sort of the geopolitical concerns, is that you've managed to say squirrel away 20 odd million pounds, and you've got probably some money coming in from Luton. What's the sort of like the direction of travel on the M&A strategy? Because not only are you well positioned with lots of funds to in ammunition to deploy, but also, you know, prices are perhaps certainly won't be going up. If you look at anything on the stock market, they're going down at the moment.
Yeah, the stock market prices are slightly different to PE prices. So, I mean, yes, I mean, the PB sale last year put us in a really good, strong position of having cash in the bank, and it's always nice to have cash in the bank because then you can make decisions when you want to make decisions. But you know, our strategy, we are picky. We're looking in highly regulated markets, and it's got to be a strategic purchase at the right price in the right markets, and have the right upside as well. There's no point in us buying something that's fully formed, if you like, and we can't do anything with. That's always the first question. What can we do with the Avingtrans kit bag? And we're targeting 15% EBITDA and at least doubling the money for the shareholders. So yes, there hasn't been any large nuggets coming along. There was a small one post year end, but that was a half a million net cost, and it was complementary to fluid handling. But we are stirring the pots, as you say, and we continue to stir the pots, and there will be something that comes along that we like, and we'll be in a good position. Meanwhile, we're continuing to invest in the business. So we've invested in the new booth building, which is now finished, and manufacturing in there. Some one-off single point failures for the aftermarket. We continue with that. The training school, and also, you know, the investment into Adaptix. That's been 4 million, and there's continued investment into Magnetica. If you remember that the commercial phase, you know, makes my eyes wince a little bit, but it's could be up to 6 million over the next 18 months because there's a lot of work and a lot of consultants to aid us on that. So, you know, yes, we've got cash. We're not going to fritter it. We don't want to fritter it away, and we continue to generate some cash. But the generating of the cash is being used to invest back into the business. But we've put back into play the interim dividend after the 4p final dividend for last year, so 1.6 pence at the interim. And of course, we're about a 40-60 split on that interim dividend, which will give you the rough idea of what it will be for the full year. But the board thinks it's an important discipline to do that. And also, we know our shareholders have costs as well as ourselves, so it's good to give a little bit back. But that's not the end game. The end game is always to give it in some sort of capital buyback way, such that it's tax efficient. And, you know, special dividends aren't really tax efficient for most people in this country.
So, Steve, just on the sector side of it, are we looking at sort of like nuclear, renewables, and healthcare are the sort of the prime areas that you're looking to invest?
Yeah, but we're still interested in other regulated sectors like aerospace, like defence, those sorts of areas, Paul. And we probably see 2 or 3 possible acquisitions a week, but the vast majority of them obviously fall on the cutting room floor because they're either too small, they're in the wrong sectors, or, you know, in a few cases, they're actually really nice businesses that are already going well. So what are we going to do with it? You know, so that's also a reject for us, unless, you know, as we have done occasionally in the past, we see a nice nugget and we can build around it and do a buy and build effect like we did at Sigma. Then we might be interested in already well-performing businesses. But otherwise, just getting bigger for the sake of it's of no interest to us. What it's about is increasing shareholder value, and you can usually most easily do that by starting from a lower base and building back up again. So that's why those sorts of targets are most interesting to us. But yeah, certainly all those sort of sectors you're talking about, but very much sticking to the knitting. We know what we're good at, and we're not trying to be anything else. So we'll stick with the knitting and stick to the sorts of sectors that we know and understand well.
Great. And then just finally, then the news flow going forward. I think, was it year end is May, is it, or something? So yeah, what's likely to be sort of the direction of travel? I'm guessing we've got the trading update probably early June or something. Yeah, probably. I mean, you've got a nice bit of news with the results coming out, which is we've now got another new non-exec director, Joe Reedman, who joins us, who's a former City analyst. And in fact, we know Joe well because she used to be our analyst at Singers. So we know her very well, which is brilliant to have her come on board. But apart from that, in terms of other news, well, it's going to be trading update, as you say, probably near around the year end at the end of May, but also probably other contract wins. And you know, maybe some M&A activity. You know, stranger things have happened, but yeah, can't promise that one because you never know when it's going to land. Okay, well, thanks very much, guys, and best of luck. And looking forward to increasing that cash pie with the disposal of the land, hopefully over the next sort of like for the rest of the year, anyway. So thanks very much, guys. Congrats, and speak to you soon. Thanks, Paul. Cheers.
Thanks, Paul.